Hi, everyone. Happy to have you all here and excited to speak with you about cryptocurrencies and how, in specific, about this market becoming an investment asset class. Over the next 45 minutes, we will answer the following questions. First, what are cryptocurrencies? Of course, our use case will be the notorious Bitcoin, but we will speak about other coins and some examples. We will talk about how does it work, the underlying technology, the ecosystem, and developments in this market. Then cryptocurrencies as an investment, how it became an investment, and why will it go mainstream sooner rather than later. We will do some comparisons, and we will talk about cryptopians and miners, and we will eventually look at the role it has in asset and wealth management. At the end, we will combine this with other fields and show why is this market so disruptive. But before starting with all of that, let me start by introducing myself. So as I said, my name is Berenson. Since 2007, when I finished my extensive military service, I've worked with companies and investors across the world, making a trade of taking ideas and shaping them to reality. From building multi-million-dollar art collections to commercial real estate deals and fundraising for innovative startups, as well as building and governing charity fundraisers. Today, I'm proud to be part of the CryptAM team, a dedicated group of professionals aiming to provide the needed approach and capabilities of traditional asset management to investors targeting the crypto space. I'm leading their commercial efforts, driving adoption and education for cryptocurrency and how to interact in this market in a responsible fashion. With that being said, let's start with how this term called digital currency even started. Back in 1983, a person called David Chaum introduced the idea of digital cash. In 1990, he founded a company called DigiCash, an electronic cash company based in Amsterdam. The purpose of founding this company was to commercialize the ideas in his research. Unfortunately, the company filed for bankruptcy in 1998, and we can assume it was due to bad timing. David still stayed a very influential figure in the cryptocurrency world. Then came eGold. eGold was the first widely used internet money. It was introduced in 1996 and grew to several million users before the US government shut it down in 2008. Users used the term digital currency to describe peer-to-peer payments in various instruments. With a few more examples, you have 1997, Coca-Cola offered buying from vending machines using mobile payments. You have PayPal that launched its USD-denominated service in 98. And then came an interesting example, actually in China, called QQ coins. QQ coins were used as a type of commodity-based digital currency on Tencent QQ's messaging platform. This happened in 2005. Now, the QQ coins were so effective in China that they were said to have a destabilizing effect on the Chinese yuan. And that was mainly due to speculations. After that, starts our story, 2009, Bitcoin was launched. Bitcoin marked the start of decentralized blockchain-based digital currency. Think about it. With no tangible assets held in reserves to back it, and no central servers, no central organization or person with the power to turn them off. Governments failed to mass regulate them over the years, and some struggle until today. So what is this thing? And let's get down to it. What are cryptocurrencies? Cryptocurrency is a digital asset designed to work as a medium of exchange. Coin ownership records and the records of new created coin are stored in a digital ledger, as well as to verify the transfer of coin ownership. This is basically some kind of a bookkeeping mechanism. Cryptocurrency does not typically exist in physical form like paper money, and is typically not issued by a central authority. Some cryptocurrencies use decentralized control, meaning there's no central authority behind them, like Bitcoin, as opposed to centralized digital currency like JP Morgan coin. The function of the JP Morgan coin or centralized digital currency is very similar to central banking systems as we know them. I want to speak a bit about the working mechanism behind all of that. And the working mechanism is actually quite straightforward. Take a wallet, for example. Like you have a physical wallet, you have an online wallet, and it's used to spend or store funds, among other reasons, but let's say that that's the bottom line. And to give you a walkthrough, let's say I have one coin in my wallet, and this coin has been offered to, say, John for fixing my fence. I've used his wallet address to send the coin and signed it with my signature. Once this has been done, it's been broadcasted automatically to the blockchain. Then kicks in a network of independent nodes that will validate the transaction. And this is a process that by itself requires explaining, but essentially those nodes are operated by miners. Miners are entities that their job or purpose is to maintain the blockchain. They are doing that by validating transactions, maintaining the books, but essentially the bottom line is they're creating consensus between all the nodes in the world to have the same ledger. And their reward for the work is newly minted Bitcoin. We will talk more about the reward system when we speak about the halving events. But back to our story. Once the transaction has been broadcasted, validated, and settled, it's irreversible and impossible to change. So T+0 settlement time. A quick note about wallets. An e-wallet comes with two keys. One key is the public key. The public key is used to receive funds and to find the transactions that this wallet did on the blockchain. From the other hand, you have the private key. The private key is used to send funds. And this is the only thing that entitles ownership in the blockchain terms. Now, back in the day, anyone could have mined Bitcoin or any other decentralized crypto on a home computer. Today, however, it's quite impossible. The computer power and electricity needed is in industrial level. Looking at developments in this market, some of the world's biggest technology giants have led some of the biggest efforts in recent years. A good example is Microsoft. Microsoft has been an active member of the Ethereum Enterprise Alliance, launching the blockchain Azure Workbench, among other contributions that they did. But similarly, you have Amazon with Amazon Web Services, Facebook Libra, IBM, Oracle, all created cloud-based services powered by blockchain. And since the release of Bitcoin in 2009, over 6,000 altcoins have been created, some of them powered by this type of technologies. Now, we spoke briefly about the history of crypto, digital money, what's a cryptocurrency, how do you use one? But the real question is why investors or people trust blockchain or trust Bitcoin? And to answer that, let's answer another question. Why people buy dollars? Why do they buy USD? Why is the USD the go-to currency for pretty much anything when there is a turmoil in traditional markets, when there is a strong amount of geopolitical tension, when you have just general big events, global events that create uncertainty for investors buy USD. It's because of the United States of America and its position as the #1 world economy. It's because of the Bretton Woods Agreement and many other reasons. For example, the role of the USD with the IMF or the World Bank, or the fact that a lot of foreign nations hold a very big amount of USD in their reserves. But simply put, you buy dollars because you trust the USA and its role in the global economy. Investors trust blockchain and Bitcoin because it's immutable, because it cannot default, and because it's impossible to tamper with. Like the USA, as long as blockchain exists and Bitcoin is setting the pace, Bitcoin cannot fail. Sure, it can have its ugly years or bad moments, but as long as blockchain exists, Bitcoin will prevail. This was an attempt to give you a showcase of what Bitcoin is all about and why crypto will continue being part of our very much reality. And another side of this attempt was the following timeline that you're going to see. And when I built this timeline, I thought to myself, what would be the best sequence of events to show how cryptocurrencies, or Bitcoin as the center of it all, gain the popularity and position they are in now? Of course, history starts with the launch of Bitcoin in 2009 as the first decentralized coin and the first transaction that happened for Bitcoin. Following that would be 2012 and the first halving event. Bitcoin value before the halving, or before the first halving, was just $2 per coin. And when we will finish the timeline, you will understand why halving is the leading theme in all of that. In 2013, a year after the first halving, Bitcoin gains 10,250%. 10,250%, and I can assure you that there is no typo in this number. Then the grayscale Bitcoin Trust you all heard about was launched. And then was the first time the word Bitcoin was voiced in a Senate hearing. Bitcoin finished the year valued $961 per coin. Then came 2014. Ethereum was launched. Ethereum protocol is groundbreaking because of the applicability of the technology in real life matters outside of the normal characteristics of cryptocurrencies as we know them. I'll share more about Ethereum and ERC20 at the end of the presentation when we talk about future applications. But in the same time, in 2014, the US government started looking into governance of cryptocurrencies formally. Then came 2015. 2015, we saw the first regulatory framework that has been announced in New York City. And Coinbase, one of the world's biggest exchanges and legitimate players based out of San Francisco, did a fundraising round, and it raised funds from New York Stock Exchange, BBVA, Docomo here in Asia, among other big players, and was one of the largest fundraisers back then. 2016, Bank of England announced it will consider blockchain technology for their settlement system. Meanwhile, the second halving event happens, and Bitcoin value then is 630 USD. Then came 2017. 2017 was full of events, full of speculations, positive and negative headlines, and frankly, there are some crazy theories of what led the bull run of that year, leading Bitcoin to nearly 20,000 USD per coin. This marking an historic year for Bitcoin, making it one of the world's most desired and hated assets. Nevertheless, 2017 put Bitcoin on the map for pretty much everyone. Then came 2018. 2018 developed to be a hard year, but it's built well on the 2017 popularity and the surge in price. And with that came the acceptance of actively managed solutions, of ICOs. The government more government acceptance, like South Korea, that announced that Bitcoin has economical value and now is widely accepted, or Venezuela launching their sovereign coin backed by their oil reserves. And for us in Hong Kong, the first formal SFC announcement. And still, market crashed big time that year. 2019 continued with a strong rebound and big announcements like Facebook Libra, like President Xi announcing China will adopt blockchain, and we launched the CBDC, their digital yuan, an event that shot Bitcoin value alone by over 20% in just a couple of hours. We have the centralized finance that took off, and notably the rise of STOs. This, with smoother performance of the market and gaining back much of the lost performance, made 2019 a great comeback year. Then moving to 2020. 2020, we saw headlines of Paul Tudor Jones and Andreessen Horowitz that are big names in traditional hedge funds, and other big names coming into the market, Grayscale with their second Bitcoin Trust, and so on. following smaller headlines about big family offices in the world, including the Rothschild family. And most importantly, the third halving event. A note about halving. We've mentioned earlier about the role and importance of miners. The halving is an unavoidable series of events built in the Bitcoin protocol, meaning that every 4 years, the rewards the miners get for their work are actually cut in half. You can hear the essentials in my video about the halving that aired recently. But the bottom line effect is that halving events will keep happening every 4 years. Rewards are cut in half every time. And this in turn creates scarcity, and less coin is entering circulation, resulting in a strong bull run within 12 to 18 months after. Up until now, those events shaped the industry and the adoption. And one good example of where we were to where we are now is one of my favorite stories, the Bitcoin Pizza Day. Bitcoin Pizza Day happened on the 22nd of May, 2010. And it marked the first ever Bitcoin transaction of actually buying something using Bitcoin. This was done by a person called Laszlo Hanyes. Laszlo was a software engineer from Florida, and he dedicated a lot of his free time to develop the Bitcoin protocol. He was rewarded with Bitcoin, and he got to a point where he accumulated a lot of Bitcoin. So he decided to make an experiment. He posted a question online asking for 2 large pizzas, any large pizzas bought or homemade, in exchange for 10,000 Bitcoin. 10,000 Bitcoin then was worth 41 USD. It took 3 days, multiple posts, even one that says, if 10,000 is not enough, we can talk about it more. Until someone picked up on the call, made the pizzas, the exchange happened, and then Laszlo sent out to the community a note that the experiment was successful, and he got his pizzas. Now, for the 41 USD value of 10,000 Bitcoin, today those 10,000 Bitcoin are worth roughly $92 million, making those pizzas the most expensive pizzas in history. And when he was asked about that, he said, it wasn't like Bitcoins had any value back then. So the idea of trading them for a pizza was just incredibly cool. And we can see that from a very cool, disruptive idea of a bunch of believers, it came to today to be one of the most pursued asset classes in the world. Moving to our next subject, cryptocurrency is a financial instrument. Look, cryptocurrencies have shown limited correlation to economic fundamental data and other traditional markets, basically leaving technical analysis and crypto-specific news as the main drivers for analyzing them. If you take, for example, the Bloomberg Commodity Index, which is often used as an allocation to commodities for inflation hedging purposes, was down about 25% this year, primarily due to crude oil trading down almost 43%. Now, meanwhile, gold and Bitcoin are up double digits. Bitcoin is currently the best performing asset class this year, and by far, and certainly in this decade. Now, the reason I made that comparison is the important point of how rare it is to find an investment hedge with such an attractive asymmetry of payoffs like Bitcoin, or a crypto asset for that matter. A hedge is something that you don't think will likely pay off, but just in case the ship hits the sand, it will be there for you to protect the potential losses of your portfolio. Hedges, if done properly, should have nominal cost and big payoffs, if in the unfortunate event that they work out. In Bitcoin's case, the potential rewards are significantly greater than the costs. And assuming it reduces the overall portfolio risk and improves the performance with a very small allocation, I think this makes the case by itself for Bitcoin as a hedge. And we've seen that with our proprietary asset allocator many times. It's widely agreed upon that investment in digital assets should be quite like a hedge. Significant potential payoffs versus relatively little cost. And even a small allocation of, let's say, 2 to 5% can have a meaningful impact on your performance. We've recently analyzed a portfolio that had some traditional constituents such as US equities and UK housing and traditional mining. When we took 5% of the US equities and we put it in crypto, we saw that not only it exponentially increased the reward or the actual return of the portfolio, but it actually lowers the overall risk statistics. So that was quite interesting to see. But since then, with all the portfolio constructing that we're doing, we can see that this happens more and more. The upside could be life-changing if sized appropriately, and the downside could be like a bad day in the markets. Couple that with the fact that this hedge is both with very limited correlation to nearly everything else, and at the same time, it lacks the term risk of most hedges. Bitcoin doesn't expire like options or credit derivatives. Now, given this, even the Bitcoin bears owe it to themselves to slow down and consider investing a small amount in this asset class, regardless of their point of view. Because if they are right and Bitcoin goes to zero, they invested little and the loss is negligible. But if they are wrong, the potential payoff could be many multiples of what they have invested. Now, prices will always seem too high and valuations will always be challenging to justify. One thing is certain, there will be moments of regret. We've all seen that. And the key to this asset is that it delivers unrelenting, punishing volatility. So bear that in mind and understand what you're coming into, assuming that this is interesting for you. Now, if we look at it from wealth and asset management perspective, other than the vast utility use, you can create hybrid products. Say, you can take Bitcoin for a volatile asset, and then you can take US Treasury bond for a stable asset, building the product on a smart contract. It will allow efficiency, minimize your counterparty risk, as well as reducing the fees for your clients. Now, even if the wealth management industry is fee-based, it can certainly be more efficient and can provide better results. More so, the idea of wealth preservation will be easier to achieve when the funds are not correlated to traditional market and using, for example, an algorithmic trading vehicle that can provide stable and standalone source of alpha. And this can be applicable for asset management as well. Furthermore, you have in the space of STOs or tokenization, more hedging instruments and the options behind decentralized finance, ensuring that there's a world of opportunities for those who give attention and willing to take the little leap of faith. The rise in 2018 of crypto asset management solved a lot of the issues that accredited investors and traders faced in the past, and some still choose to struggle with today. Crypto asset manager is a safe way to come into this market and understand the nuances. It can provide consolidated portfolios of different coins, the professional tools to optimize the returns of these portfolios, rather if they're only cryptocurrencies or a mix of traditional and crypto. And finally, the matters of security, which we're going to talk about next. Even taking into account the management fee of 2%, according to recent reports, those crypto asset managers gain 20% and more annually. So it's a small ticket to pay for such a comfortable and comprehensive solution. In the next slide, I want to talk to you a little bit about adoption. And we chose to show that through the growth of using e-wallets. We thought that that would be similar to how banks measure the growth by new accounts opening. Now, according to a study done by Statista and published in Bitcoin News, but in the time of the first halving in 2012, you could have seen 5,800 e-wallets registered. Since then, the market developed in an exponential rate. In Q1 2016, just before the second halving, there were 6.7 million users. Then Q1 2019, 36.7 million. And now it's estimated to be well past the 40 million mark. Now, digital wallets, as we said, they're used to store and spend your coin, but they're a great piece of tech and they can do quite a lot of other things. They can hold any digitized representation of traditional identity documents, such as a driver's license or passports, birth certificates, social security and Medicare cards, and all the way to voter registration info and voting records. This essentially allows a person to control who has access to any sensitive information. And if speaking of identity, we must touch on the matter of security. When discussing matters of security, there are a few things we need to take into account, and it's better to break those down to three categories: technology, behavior, and third party. We've said previously that blockchain is immutable, and that's broadly correct. Because in order to tamper with the information recorded on the blockchain, one entity must have 51% and more of the hash rate or computing power, or essentially 51% of the total nodes in the world for that blockchain. It's called the 51% attack. As there are tens of thousands of nodes, the likelihood for this to happen is not really realistic by nature. And even if this would be the case, to get to a point where this entity can make damage on historical data or tamper with personal wallets is not really feasible. The second and more important part is human behavior. Theft and fraud are the more likely scenarios when phishing emails, Trojan horses, and ransomware attempts are strong reality every day. This goes far beyond the cryptoverse, and applying simple security measures is quite essential. Measures like two-factor authentication, security challenges, updating your software often, and just keeping backups of the information on flash drives or cold wallets and put them in a safe at home. Those are just some of many options. Lastly, there is the third-party risk. This is a lot in the news, and when you put information on places like exchanges, service providers, or all kinds of web domains, you don't really know where they end up. So do a lot of due diligence. Ask advice from people that trade or hold coin in your network. Now it's much more common than it used to be. Send me an email. Do a lot of research. There's so many things that one can do to understand where they put their details. Today's technology is very advanced, and the faults are usually a result of human errors. Exchange hacks today are not as likely as they used to be some years ago, and the technology keeps up very well. You can see solutions like vaults within vaults, or all kinds of automated anti-fraudulent type of tools that they have on exchanges or external softwares, and the list goes on. But there's always a chance that something might happen. So you can certainly minimize the exposure that you have to risk by applying some of those tools. Look, the bottom line is find a comfortable setup for yourself after doing a lot of due diligence. You're not day trading, and you're not likely to rebalance this portfolio very often. So put something together that you sleep well at night with, but won't give you an anxiety attack twice a week. With that, we should speak a little bit more about the future. And this is just before wrapping up, so I'll try and make it brief. I believe over the next decade, we'll see cryptocurrencies reach from hundreds of millions to 1 billion users thanks to technological improvements and institutional and government adoption. Adoption will happen in two main fields. Firstly, in emerging markets, where the financial systems are most broken, with high inflation rates and large remittance markets, where crypto can really shine. Second is obviously innovation. If it's creating products people want and need, or improving current features in existing products. Then in the 2020s, one of the drivers for cryptocurrency adoption in emerging markets to scale to hundreds of millions and more users will be due to at least several countries tipping so that the majority of transactions in their economy happen in cryptocurrencies. A good example for that would be African nations with stronger adoption and maturity in mobile payments and generally with mobile phones. Another good point is consolidation. We've said 6,000, there are probably much, much more than that. And there are already many tokens and coins as there are companies and open source projects in the world. So only a handful of chains will power the underlying infrastructure of these. The winning chains will likely follow a power law distribution on outcomes. So it's pretty much going to happen like any other industry. So follow those. And this leads me to a very important shift, a shift that you all should pay attention for. The shift from trading to utility. The 2010s was largely about speculation and investment in cryptocurrencies. with trading driving most of the activity and best business models. Of course, this trend will continue to play out in the 2020s, but I believe that the best new companies to get created in the crypto space in the 2020s will be about driving the utility phase. We've already started to see the beginning of this trend with Ethereum and ERC20 tokens. This in turn rewards directly the native coin, the Ether, for example, of that blockchain. Similarly, this will further boost the interest in products like staking, borrow lend margin, debit cards, e-commerce, the use of IoT in blockchain, big data, and just daily use of those applications that are both financial and non-financial related. The next phase will be central bank digital currencies. You've heard about the CBDCs before, and we see China leading the way with the digital yuan. But this will surely drive adoption of the initial coins further. Just about the adoption of technology that will ease the barrier to entry for so many investors and other institutions that need the little push. But look, just to wrap up, do your dollar cost average. Do think of this as a small piece of a larger asset allocation. Do tinker around and see what all the fuss is about. Open an e-wallet. Try moving money from one account to another, just a small one. Send some to a friend. Experience the freedom of not relying on a bank or intermediary. Just go with it. You can be part of something revolutionary. And you will make mistakes, we all do, so only venture in with a small amount of capital. Do not invest more than you can afford to lose. Do not invest everything at once. And make a plan. Do not deviate from that plan. Given those thoughts, if you're wondering how much or when to invest, one option is to reach out to us. Here at CryptAM, we have been actively trading our books of cryptocurrencies for many years and have developed in-house expertise, knowledge, and tools to help those wanting to invest in crypto. A more elementary option would be to follow a rule I recently heard that's quite interesting, the rule of 3. No more than 3% of your investment portfolio. Dollar cost average with 3% of your income. Have a 3-year time horizon. Now, those are just guidelines, but every person can adopt those as they wish. So come on in, the water is warm, dip a toe in the shallow end, see how it feels. Will all of that be true? Maybe. What we can be sure of is that everyone will have to take part in some point. The day is not far when you open a bank account and you will get an e-wallet to go with that. Situations like this usually benefit early adopters. Then try and adopt. In this market, what we can expect is growth and development. It's already reinventing many of the terms that we know and gradually become obsolete. So why stay behind? With that, I'll conclude. Thank you very much for your time, and I'll be happy to take questions now. All right. Why is there such a gap in valuation between Bitcoin and all the other cryptocurrencies? Okay, Bitcoin. Bitcoin was the first coin, and because of that, it has the longest history. It has the biggest supporting community, and it has the widest recognition. Furthermore, due to events like halving and the cost of mining, the scarcity is growing, and the cost to generate the coins is growing steadily. So those are just some of the main reasons. You can add that to the value it has as a tradable asset and the fact that most of the use cases for trading and financial instruments are mainly around BTC. All right, the 2017 rush. Many ICOs made a lot of people rich, but most of them turned out to be frauds. Is STO just repacking of the same thing? No, not at all, actually. ICO is a token offering, and this is similar to an IPO, and used to raise funds for a company or a project for when it's going to be launched. ICOs are largely unregulated, and because of that, it's putting the investors and their funds at risk. STO is a token offering, which has the similar characteristics as ICO, but they're actually fully regulated. In ICO, companies define the use case for their tokens to raise funds. However, a small portion of this fund is actually needed. And when in an STO, founders don't need to invest in a use case because all tokens are backed by something tangible. In addition, investors cannot distribute or gain profits as they don't have any rights with ICO. When in STO, they have legal rights and revenue distribution, as well as security in case the tokens get stolen or hacked. And lastly, STOs are much more transparent than ICOs. If ICO go bust, you lose everything and you don't really know what hit you. When STO are regulated, so there are safety mechanisms that depend. It depends on the project, but you have safety mechanisms. Okay, how do you evaluate whether a cryptocurrency is worth investing in? Okay, uniqueness of the crypto and its use, the team behind the project and the community, if it can be easily used and adopted, circulating supply, market cap and liquidity, trading volume. You have quite a lot of reasons, but I'd say that those are the main ones. Okay, what's the best way to create exposure with the least possible risk for the average investor? I think we covered that a little bit. Open a new wallet in a reputable exchange, better one that's never been hacked, just to be on the safe side. I have an account with Coinbase as an example. Do some due diligence on where to open and the best exchanges. Follow the guidelines on do and don'ts when buying on an exchange. There's plenty of reading materials for that online. Buy one coin. Doesn't have to be Bitcoin. It can be Ethereum. It's about 240 USD, 220 to 240 range. It has good liquidity. It's widely traded. Then find a friend you know and trust that has a wallet. And as we said earlier, tinker with it a bit. Do it with a friend who's interested. Always better to experiment together. And from there, there's just growth. All right, that's a lot of everything. Thank you very much for your time. I'm here for any other questions through my email or, just be in touch. Thank you very much and see you in the next webinar.